So let me just switch I want to finish off with a couple of tax planning issues. Again, not trying to make it too boring, but there are some interesting changes that affect executives and partners in law firms. They can now incorporate. And before that, they had a whole bunch of serious issues. They had to take 100% of their salary and bonus directly. Their maximum tax rates were 44% over $128,000. They couldn't split income with spouses or children, and they pay maximum tax rates on investment income. So they were basically hooped. Now, this is an example of something that they can acquire. It's called an IPP. Some of you have an IPP. An IPP is really a corporate version of an RSP, so it allows you larger contributions. This is for a 65-year-old. $37,500 would be allowed to go in each year. If you have worked for your own company for the last 20 years, government might allow you to put in an additional $325,000 as a one-time past service deposit. And they would be really generous and say, you know, if you're going to retire right now, we're going to let you fund this as if you were a civil servant. So we're going to treat you nicely just this once and let you put in enough money to have a gold-plated pension plan. So you can actually put in enough, in this case, to have $837,000. And we actually have done this for a number of clients who are about to retire because it actually works out to be a very, very good transaction. So when somebody's selling a firm, for example, and may have a large taxable capital gain, this is a very interesting way to defer part of that gain through their pension arrangements. So basically, let's assume this person has $1 million salary and $100,000 of investment income. Right now, they're paying almost $500,000 in taxes. If they were to incorporate and do the following, create a personal services corporation, their tax rate would go to 26.5%, next year 25%. They would get an income split with their children over 18 and their spouse. They would reduce their tax rate on their investment income to 19% versus 44%. We've written a lot of articles about this, so I won't go into the details of how they work, but you're more than welcome to come to our website, and there's lots of information about this. And we would do an IPP, of course, for the reasons I already mentioned. The net result in this case for this particular client was a reduction in their annual tax bill of $126,000 a year. So whether they were a partner in a law firm or whether they were an executive for a major corporation, this is a very attractive tax planning strategy. For those of you that are simply in a normal professional corporation or business corporation, just a quick reminder that if you're over 500,000, you would take a salary only to $125,000 a year. If you are over 45, it makes sense to have an IPP. And you would arrange with your accountant that dividends paid to a family trust would be what are called GRIP dividends. I won't get into what a GRIP dividend is. It's far too boring. But if you just speak to your accountant, they know what it is, because accountants like boring things. So I didn't mean, there's probably some accountants here, aren't there? I didn't, but don't take it personally. Under 500,000 of income, no salary or bonus at all, dividends only, which means I'm using a family trust, no RSP or IPP, unless you're a doctor, and then there's some techniques we use for matching BCMA grants. So let's talk about the ideal tax haven. I just was fortunate enough to get back from a very nice, warm winter holiday. Unfortunately, it wasn't a tax haven, but my definition of a tax haven is they have low tax rates, good health care, great weather, good food, and wine. I mean, this would be pretty hard to beat. So let's just see how Canada stacks up, okay? So let's just see how close we can get, okay? So we potentially have low tax rates, if you're incorporated or not. We have, good health care, maybe not the greatest health care, maybe some issues, but, better than many countries. We have grim weather as opposed to great weather, and of course we have Timbits and ice wine. So we didn't score on all of the points, but we had some of the points working in our favor. But if you're retiring, the situation may be actually a bit more attractive, depending on what you define a tax haven as being. So we want to give you a little bit of a story here. It's called The Tale of Two Couples. So let's meet these couples. The first couple are the basics of this couple right here, a good-looking couple. They're named Fred and Ginger Rogers. They want a relatively, considerably higher than average $250,000 a year after tax to retire on. They want to take bike trips in the Loire Valley. They own 2 homes. They want to help their kids with housing. They love to travel. They like to tango. Of course, with names like that, you'd expect that. So that's what we'll call our high-end couple. Now, our slightly lower maintenance couple, who's also retiring at the same time, they look a little different. You need to meet Edna and Elvis. And they only need $120,000 a year after tax. They own a Winnebago. They spend winters in Las Vegas and Graceland. They're going to help their kids rent a house. And they like to travel, and they're very good at the job. So these two couples are looking forward to, and our job is to try to determine how they're going to live well during retirement. All right, so let's imagine these couples. We're going to divvy up their incomes to keep them diversified. So we've got these 5 categories: registered income, insured annuity, preferred shares, real estate, and equity income. And what you're looking at here is what percentage of this income is taxable. Only half the income from equities, whether it's in the capital gains form. Roughly 75% of real estate income is taxable, net of depreciation is allowed. 50% of preferred shares, only 30% in the case of an insured annuity, and 100% in the case of registered income or CPP. So we're going to blend all of these together nicely, and we're going to deal with Fred and Ginger first, and they're going to get $300,000, and 106 of that is not going to be taxable at all. We're going to take the rest of it and split it between the two of them, and when we do that, there's $194,000. So when we look at them individually, they'll have $150,000 of income. That's their tax bill, which is only 15% at $250,000 a year of income. So that's actually quite decent. And in fact, if they were really quite generous, which they are, and were giving money to their favorite foundation or their PPF account, 10% of their income each year, their tax bill would drop so that their tax rate was now down to 10.6% of their entire gross income, which is in excess of $300,000 a year. So they don't have to do anything really fancy. They're not buying flow-through shares. They're not doing exotic, going offshore, trying to diddle the Canadian government. They're basically earning a lot of money at a very low tax rate. And if we take a look at Edna and Elvis, because we don't want to forget about them, of course, their situation is that their income is about $67,000 each, gross. Their tax bill is only $6,700 in the first place. They're already at a 10% tax rate. And if they decided to be generous as well and give, say, 10% of their income to the local wedding chapel in Las Vegas, they would get their tax bill down to 6%. So these are fairly straightforward planning issues in terms of the tax rates. Most of you, I believe, would expect at this level of income, even the second level of income, that you would be paying far more tax in Canada than the numbers we're looking at here. So why does all of this work? Well, there's a lot of tax-free cash and credit. So for starters, insured annuities and prescribed annuities have much, much lower tax rates than bonds do. Dividends are taxed at about 50% rate of interest. We're going to income split equally, which we're allowed to do with both RIF income, pension income, and effectively we can accomplish the same with holding company income as well. And we can create gifts, and when you donate money, you get to deduct it at the highest tax rate, even if you're at the lowest tax rate. So in the case of, for instance, if I took somebody with $100,000 of dividend income, they would only need to donate something like $30,000 or $40,000 a year to eliminate 100% of the tax on that income. So there's a lot of ways to come up with very creative ways of giving. So, not a bad tax haven, eh?